Hi there and welcome back. Today we're going to be looking at the risk-adjusted returns of a 1-1-2 options trading strategy. Let's dive in. So you're probably wondering, what is this 1-1-2 strategy that these people are talking about? Well, it's a variation of a put-front ratio spread. It's the reverse trade of a back ratio spread. There's certain risk involved with this trade that the general public is not aware of. One trader online stated that he's placing 30% of his entire portfolio margin buying power into this trade. Well, we're going to analyze that risk. We're going to see how this trade performed over the COVID crash. So here's the 1-1-2 trade that we're discussing, and I've built it just ahead of the COVID crash. So this looks a lot like an unbalanced condor, but there's a huge difference. You're exposing this trade to large moves in volatility because it has a very strong negative Vomma position. And with the negative Vomma, well, as volatility increases, your negative vega becomes even more negative and your losses snowball. The trade also comprises a really poorly designed Lambda position. So what happens is when the market moves down, those out-of-the-money short puts increase in value much more than the protective longs, and thus they end up causing a lot of damages to this trade. And just really quick, the Vanna position of the trade is also really bad. It's a long Vanna position, and that causes the vega of the trade to dynamically shift against you with every price move of the underlying asset. And although it appears that this trade could make money on the downside, covering a span of roughly 15%, we're going to see today what happens in the real world. So as we step through the time of the trade, we're going to pay attention to that buying power, we're going to pay attention to the drawdowns, and we're really going to observe what happens when there's a quick increase in volatility and a fast drop in price. So the next slide we're looking at is the price chart of SPX, and you can see February 19th is just ahead of that massive COVID crash. So let's move to the next slide. You'll see on February 25th that the margin requirement of the trade has already increased to $217,000. In other words, in only 5 days, you've already had a margin call and you're basically been put out of this trade unless you deposit more money into your account. So although this trade covers 14% to the downside, you can see how if the market moves fast, you can't utilize the span. So now we're going to move a few more days to February 27th. So essentially you're in the trade about 8 days. And at this point, the trade's down $175,000. So your $200,000 account now only has $25,000 remaining, and your margin requirement at the moment is over $300,000 if you wanted to maintain the trade. So now we're moving to March 9th, and now you're in the trade almost 3 weeks. The trade's currently down $481,000. And the margin requirement is $377,000. So you can see how this type of trade quickly snowballs against you when the price moves down quickly and the volatility increases at the same time. Next slide, March 12th. Now you're down $874,000. And on top of that, you still have to have an additional buying power of $412,000. Next slide. So now we're essentially at the bottom. The trade is down $1.3 million. The buying power requirement is still over $400,000. But see, this is all hindsight. When this is happening, you don't know where the bottom is, So you're constantly wondering if you should exit the trade or if you should stay in the trade, put more money into your account. This type of trade, as you can see, turns into a nightmare whenever there's a serious meltdown in the market. The next couple slides will just look at a timeline of the actual profit and loss, or just loss of the trade. And you'll see again that the account was pretty much wiped out within the first week of this bearish move. And then it just took about 1 month for the trade to be down $1.3 million. And again, this trade started with a $70,000 buying power requirement. Next, let's take a brief pause to acknowledge our sponsor, Option Colors, the industry's leading volatility trading platform. And stay tuned, because when we return, we'll dive into the final analysis of the 112 strategy. Embrace yourself as we reveal the shocking outcome of the trade.